Welcome to this episode of CEO Perspectives. CEO Perspectives are conversations that take an objective, nonpartisan look at a range of subjects that matter most to business leaders. I'm Steve Odland from the Conference Board and the host of this series, and in today's conversation, we're going to do a deep dive on the collapse of two high-profile banks. In our wide-ranging conversation, we're going to discuss how the new regulations that followed the 2008 financial crisis failed here, why, and regulations aside, where were the basic management mistakes? Where was the board? And lastly, from a governance perspective, what do we have to do to make sure it doesn't happen again? We'll unpack all those questions and more in today's conversation with Paul Washington, the Executive Director of the ESG Center here at the Conference Board.
You are listening to CEO Perspectives, a podcast by the Conference Board.
Paul, welcome.
Delighted to be with you, Steve. Thanks.
So, Paul, your claim to fame now is running the ESG Center at the Conference Board, but you do have a background in governance and banking, which is a great combination for today's conversation. Tell our listeners a little bit more about what your experience has been in that area.
Sure. Well, I had both the good fortune and the misfortune to start my career in the private sector during the savings and loan crisis in the early 1990s. I joined the Dime Savings Bank of New York, which is one of the biggest savings institutions on the East Coast, 1989. I was there through 1995. During that time, the bank almost went under. And we experienced all that you could kind of go through during that time. We faced significant credit risk. The FDIC said we were in danger of imminent seizure. They rated us as number 5, and we were the only bank that went from being rated number 5 to being rated number 1, which is the best capitalized, best run banks, within about 18 months. And we did that in part by improving our governance. We went from having the FDIC say that our board was violating its fiduciary duties to saying it was one of the best run boards they'd ever seen.
Wow. I mean, that's a great story, and it's a success story, which shows you that not all of these issues need to end in disaster. But we have had a couple of disasters recently, and that is a little scary given that we thought that we had corrected all of this in 2008. Talk a little bit about the Silicon Valley Bank and Signature Bank, which both collapsed, but there is also in here the Credit Suisse situation, which has had to undergo a forced marriage with UBS. Just talk generally about what happened with each of these.
Sure. Well, let me talk about the U.S. institutions in particular. So these were classic examples of runs on the bank. And that's something that can threaten almost any institution. And what happened here was that about 78% of the deposits at SVB were uninsured, and about 90% of the deposits at Signature Bank were not insured by the FDIC. That's because they were over the $250,000 limit. And when the depositors lost confidence in those institutions, they withdrew their money at a remarkable rate, $42 billion flowing out the door at Silicon Valley Bank, for example. And no bank really is able to withstand that kind of withdrawal of deposits in that short amount of time. So the depositors panicked, and the only way the bank can cover those withdrawals is by doing a fire sale of assets. And in this case, the banks didn't have the assets to support those withdrawals.
Well, and they did originally, but the value of those assets had declined so much because of interest rates, which is another whole wrinkle in all of this.
Yeah.
That leads us to a discussion of tenor, the length of investments that banks make with depositors' money versus the loans that they make, which was in this case long on the investment, short on the promises.
And banks basically face, I think, 4 types of risk that are just core to managing the business. The first is interest rate risk. You take in money and you've got to pay your depositors whatever the market requires to get the deposits in the door, and then you have to invest them somewhere to earn the money to pay your depositors, right? And in this case, both banks had invested in assets in treasury securities and other securities that were long-term. And so when interest rates went up, the value of those assets went down. We have seen this movie before. This is exactly what led to the S&L crisis in the early 1990s. So we have seen it before. The second great risk that banks face is credit risk, which is you lend money to people who aren't going to pay you back. And that's what we saw in 2008. There are a couple other risks that sit out there for banks. One is regulatory risk. That is actually the regulators may take action that is not in the best interest of your institution, may force you to shut down prematurely. And then the final one is liquidity risk, which we saw here, which is having enough cash on hand to pay your depositors. And that can be driven by a crisis in confidence. So, what you saw here was interest rate risk, which people thought had sort of been put to bed, decades ago, has reared its head and led to basically liquidity risk run on the banks and then the collapse of those two institutions.
Wow, it seems like enough risk clearly to sink anything. But
yeah,
Paul, I thought in 2008 we went through a crisis. You obviously went through the savings and loan crisis before that. We've got regulations from every crisis that we've done and piled one on top of the other. And so, every time we go through this, we do more regulations and more laws, and then we find out they weren't enough. So why didn't the regulations that we put in place before cover this?
Well, I think some of what we saw in the wake of the financial crisis of 2008, 2009 was focused on credit risk, which was not present here. Some of it was focused on shifting more power to shareholders and away from the board. And that's not really what was at play here. I actually think that what happened here is a failure of basic blocking and tackling. And that's the management of interest rate risk, credit risk, the other risks. I mean, it's just core risk management that was really the shortcoming here. And, that's something that all the rules in the world will not necessarily save you from if management's not doing its job, if the board's not doing its job. And in this case, there's the question of whether the regulators who were doing their regular evaluations of these institutions were moving quickly enough to when they saw problems and forcing the banks to take faster action, and whether the regulators themselves were focusing sufficiently on interest rate risk, which everyone thought had been put to bed decades ago.
Right. And so no, that's mostly Silicon Valley Bank, SVB. Let's talk a little bit about Signature Bank, because that is a New York bank.
Yep.
And ironically, on the board of Signature Bank was none other than one Barney Frank.
Correct.
The co-author of the Dodd-Frank bill and the regulations that were supposed to have cleaned this up last time. So what is the deal with Signature Bank?
Well, in that case, this is really an issue of contagion. I mean, because so much of their deposits came were uninsured. I mean, about 90%. That when the tech investors, the tech depositors in California panicked over Silicon Valley Bank, it had a direct contagious effect on the depositors in Signature Bank. And that bank, as you point out, it was a state chartered bank. And then the state of New York, the banking department and the FDIC moved to shut it down. Okay,
now there is some political overtone here that, because Signature Bank was heavily involved with crypto, that they were unfairly dealt a hand here.
I honestly don't see that. Sure. Signature Bank took some crypto deposits. It wasn't a huge percentage of their deposits. That's not what caused the threat to the bank, the run on the bank. I don't see this. In fact, my one hope, but I think it's a bit of a futile hope here, is that the analysis of the issues that led to the downfall of these two banks isn't politicized, and that the solutions aren't just let's take off the shelf those ideas that we've had about bank regulation or executive compensation or whatever it is that's been sitting around, that have been sitting around for decades that we haven't been able to get into legislation, and just plug them in as a solution here. I think that's sort of just grabbing things off the shelf to solve yesterday's problems with, whatever's at hand isn't the approach here.
Right. Okay. So coming back to ABCs, because that's what you're saying. It's basically you're saying it's mismanagement, because it's just it's a failure to keep your eye on interest rate risk, which you're saying, which sounds fancy, and it's one of the 4 risks. And if you're not in the banking world, it sounds like, oh my word, that is really complicated and confusing. But if you're in the banking world, that's like walking, talking, and drinking water, isn't it?
It absolutely is. And look, this is something that goes beyond just financial institutions. A lot of the leading companies in America are incorporated in Delaware, and there's some Delaware court decisions that have come down and have said that the board of directors has a duty not only to make sure the company has an adequate system of internal controls over risk, but that they're actively monitoring it. And that goes to core business risks. So there's a decision in the Boeing case, which is the airline safety, decision in what's called the Blue Bell case about food safety, about ice cream safety. So by, parallel reasoning here, your board has an obligation to stay on top of the systems that are there to monitor interest rate risk, credit risk, and all that. The board has to be able to understand what's going on. But I'll take this a step forward. The original failure here is with management, and happy to talk about that.
Yeah, because the board's an oversight group. It's not a management group. It doesn't run day-to-day operations, and so this is a group of managers who apparently didn't get a memo that the Fed was raising interest rates, and so therefore that their value of their treasury securities, in which they had invested long-term and all, using their shareholder money and their depositors' money, that would drop in value. When interest rates go up, those bonds that were prior to that are less valuable, and the price drop because the new bonds are at a higher interest rate. Well, this is just, this is basic 101.
It is. That was what I was going to say. This is 101 stuff, but I can tell you from my experience working directly at a bank and then knowing a lot of other folks in the banking industry, but this applies even more broadly, is that there's a lot of denial that happens here, right? The bank has adopted a strategy, an asset liability management strategy, and they stick to it even when it's pretty clear that it's not going to work out. Another thing that goes along with this denial is, because it's not just out and out denial, you've got to have some reason to deny it, is they will say to themselves, well, we've got a model. We've modeled all this out, and we've got this guy who sits a few levels down below the CEO who's really run this all through the model and will be fine, absent some catastrophic event. So what I think is really at issue here is the CEO, the CFO, the senior management of the bank really has to have a robust, honest assessment of risk and acceptance that those risks are existing, and then face them head on, because we've seen this movie too many times.
Well, and all of that is undoubtedly true. But you just sit there and you go, okay, we're going from a zero interest rate environment. The Fed has moved over 400 basis points. Those bonds that we bought at zero, effectively when the discount rate was zero, are going to be worth less. We've got a whole bunch of investment there. If anybody finds that out, that's going to cause some panic. The first thing you do when the Fed starts increasing interest rates is you change the portfolio of your investments, right? You don't just sit and say, and it wasn't like they were trying to fix a tiny little problem. The Fed, they telegraphed it. It took a year to move 400 basis points, and then they were telegraphing it's going to be at least 100 more at that point, maybe even beyond that. They couldn't have. This was no surprise.
You're right. There was no surprise here. People saw this coming, but I think. The Dime Savings Bank went through this near-death experience with credit risk. And then, guess who bought the Dime Savings Bank of New York? Washington Mutual. Washington Mutual made a carbon copy of the mistakes that had been made at the dime. Literally the same mistakes, even with some of the same board members who served in both institutions. So I think there's just something about human nature here that plays out, which is people sort of don't want to face up to the risks. They think they may be smarter than it. They think they may have better systems than they had in the past. They think they might have hedged against it, although in this case, they didn't. And so, it's to my mind, it's a fundamental failure of honest risk assessment and honest risk management.
Okay, but also, if they had said, okay, interest rates are going, we're going to have to sell these bonds in advance, they would have had to take a loss.
Correct.
And that would have hit their earnings per share because this bank was a public company, meaning that it has stock that traded on a public exchange. So therefore, they would have hit their stock price. And so what's your view of that? Is this all driven because they didn't want to hit the stock price and they said, "Oh, we'll just outlast it and we'll keep the stock up and everything will be fine"?
I don't know because I wasn't in the room, but I will tell you that there is sometimes just a fair amount of wishful thinking, or someone will say, well, you know what? That's what other people predict will happen with interest rates, but we actually think the Fed's going to stop. We'll have time. And look, over time, right? Over time, this all could have worked out, right? Eventually each of the banks would have been able to turn over their asset portfolio. But the issue was that people didn't want to, I think, face up to the real risk they were running as they're reporting their balance sheet information, that there could in fact be a crisis of confidence in the institution. And that's something even the best boards and even best management don't want to admit, that they could face a crisis of confidence when word gets out. And that's what happened here.
We're talking about governance and bank failures. I'm going to take a short break and we'll be right back.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge, from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to CEO Perspectives. I'm your host, Steve Odland from the Conference Board, and I'm joined today by Paul Washington, the head of the ESG Center at the Conference Board. Okay, so Paul, before the break, we were talking about management's role in this, and how much of these bank failures are just ABCs. Let's just pivot a little bit back to the board. You mentioned the board of directors and their oversight role. What should the board have done differently?
Right. Well, this is based on publicly reported information, but I'll just talk about SVB. I think it's been reported that organization went without a chief risk officer for several months. I think that was one of the issues that's like running without an engineer for your ship, right? And that's
No
a real
oversight.
that's a real
No internal oversight.
That's a real risk. Another issue is whether the board had individuals who had experience in the industry or in aligned industries in an area of risk management, right? Apparently that was absent here. Now, not saying that everyone who serves on a bank board needs to be a former banker. That's probably not even a healthy thing to do, but you have to make sure that you fully understand all the risks that you're being faced with. The other thing that is really striking to me is that in this case with SVB, the Fed issued warnings to the bank. It was delivering regulatory reports telling the bank what it needed to do. And, I can tell you from my own experience, a board should be highly responsive to that. Sometimes those reports are written in a slightly obscure and oblique manner, but from what's been reported in the press, that board was on notice that the regulators found very fundamental issues. And the board, this was a time months ago for the board to be calling emergency meetings to address the problem.
Okay, but let's go back to this composition of the board, because this is an issue in banking, but it's an issue across every industry. And you've written about this and spoken about this. As we have sought to diversify boards in every way possible, in some cases, we have moved away from requiring that there be a skill set that is appropriate to whatever business they were in. And so in this case, a lot of smart people, a lot of good people, but without a lot of banking experience.
Yeah. So you want people with industry experience. You want people in adjacent industries. That's also very helpful. You want to make sure you have a very robust director education program because, in this case, these were fundamental risks that everyone on a board should be quite familiar with. But we are living in a world of evolving risks, evolving crises, and evolving opportunities. And so, taking board education very seriously is something that companies ought to do. So, for example, just because you have the author of the Dodd-Frank bill on your board doesn't mean you've got regulatory risk or credit risk covered. You actually have to make sure that all of your board members are fluent in all of those major risks that banks face, because they all need to be able to work collaboratively to address them. In fact, having one sort of outsized expert on your board, don't care what kind of industry you're in, can pose a real risk.
But going back to the fact that these are public companies now, banks used to be family owned. They or they were partnerships where partners pooled their own money, and so the risk of their investments and of their loans were personal to them in the sense that it was a personal loss to board members, management, if any of these things didn't play out. Now, when you're raising capital through the stock market, through public markets, it kind of becomes other people's money that you're playing with. Talk about the moral hazard of banks that are public companies versus private banks or partnerships.
Yeah, well, actually, the Dime Savings Bank of New York, where I started my career, started as a mutual institution where it was effectively owned by its depositors, right? And then it converted to stock ownership. You can be a successful bank. The world's leading banks are publicly traded. That's what the leading banks in the world are. They raise money through equity markets, and if they're well managed, that's good for the system because there's more money flowing into the banking system, which is the lifeblood of a capitalist economy, right? And so it's actually a good thing to have, in my view, to have public companies, have banks be public companies. They don't all have to be it, but I think that is a good model. But I think what goes with being a publicly traded bank is a profound sense that you are custodians of the public's trust. Your deposits are either partially or, depends on what happens, entirely insured by the FDIC. You have a responsibility to our economy, to our society that runs in many ways deeper than almost any other type of institution. I mean, it's essentially the same kind of moral obligation that you have in the healthcare industry, right? And I think you have that in the banking industry. And so I think that requires sort of a different mindset, perhaps from your board members, a different mindset, perhaps from management, and frankly, from the investors who put their money in these institutions. I'm not sure that investors who are looking at investing in banks should be looking for a whole lot of outsized alpha returns, right? They should probably be more focused on steady, reliable returns than on making a killing in the market.
And this goes back to stakeholder management, because you're not just taking care of one stakeholder, you're taking care of multiple stakeholders, customers, employees, owners, community. environment, and you've got to make it all work. You've got to do it all in balance, and the public trust, which is serving the community, is so important, not just to banks, but to many
Yeah.
industries. Whether you're talking about industries that rely on environmental or natural resources, whether you're talking about utilities that provide the underlying electricities, in the energy that supports our country, whether you're talking about food, that feed people. I mean, all of these things, and so then you wonder, well, should there be some sort of ESG gauge or ESG measure that takes this all into effect and risk being part of that?
Yeah, it's something. First of all, I agree with you. It's not just about banks, but banks do, as we've seen, have the capability of taking down the world economy, right? And so there is a special responsibility there. And the notion of stakeholder capitalism, that you need to balance the interests of and serve the interests of investors and customers and employees and communities and society at large, is especially true in the banking industry. And I'll tell you, one of the things that has been striking to us in our research, we recently put out a report on the role of the board in the era of ESG and stakeholder capitalism, is that boards actually feel, and they probably are doing a better job at looking at how well they're addressing certain discrete issues, like, oh, here's how we're doing on greenhouse gas emissions or on water or on diversity, equity, inclusion. Boards do not necessarily have the same way of assessing how they're doing at serving the long-term welfare or even the state of their relationships with stakeholders, of employees, customers, and others. They may have obviously consumer data, like, yes, our customers love us, and they get some reports, but that sort of more comprehensive look at how you're serving multiple stakeholders, including the public at large, that's not built into board strategic planning, board risk assessment, and some of the fundamental board processes that companies have. So I think that's an area of opportunity for boards, is to build not just the what of ESG topics, but also the whom of stakeholders into their everyday decision making.
Okay, so given that a lot of this was, the ABCs or, banking 101 kind of mistakes, what regulations need to change, what new laws need to be changed, or what monitoring practices need to be changed? What should be done here to try to ensure that something like this doesn't happen again?
I think that one thing I would take a close look at is the approach that the frontline regulators are taking. The people who come in, the bank examiners, the bank inspectors, the people who come in and look at the bank's balance sheet, who look at its processes and so forth. I take a close look at that because in each case here, Silicon Valley's main bank and Signature, they were both state chartered institutions. And at least for a long time, federally chartered institutions tended to have more effective regulation than state chartered institutions. Also, we are working in an era where a lot of bank examiners have been working remotely. And I will tell you that I think this goes back to basic blocking and tackling. I would look at the quality and caliber and training of the bank examiners. I would look at the support they're receiving from their own management within the regulatory agencies. Are they getting the backing they need when they go into challenge management? In some cases, as was the case here, there can be a conflict of interest where the CEO of the bank you're regulating is actually serving on the regulatory board. That was an issue way back in the 1990s with the savings and loan crisis. So I would look at the conflict of interest issue, but I would really look at the quality of the bank examination process and make sure that it's fully robust, because I think that, again, these things often fall down when you're talking about the people involved and the training they receive and the support they receive from their senior management, when the bank examiners are sometimes making tough calls and they got to be backed up.
Liquidity rules?
Yeah, I think that's an area here. I mean, I think that what happened here with the level of deposits that were were uninsured. And, that can be addressed in a couple ways. One would be by raising the FDIC insurance limit. Another is by looking at, how much of your balance sheet can be uninsured deposits. I mean, the average of banks is a fraction of what we saw at these two institutions. I'm actually sort of surprised that they were able to get away with that.
Well, and then, should there be hard and fast rules about the tenors of, the mismatch between the long-term investments and their commitments?
Well, you would hope that would just be done through the regular asset. Every bank has an asset liability management committee, right? They all have the mechanisms. I think a lot of this has to do with, are the people qualified? One of the issues, and we've highlighted this in other areas, Steve, that sometimes the people who are responsible they're on the board, or they're the CEO, or they're leveled or so down, they haven't been through some of these crises before. They didn't go through the 2008 crisis. They certainly, only a few of us are around long enough to have gone through the S&L crisis back in the early 1990s, but those lessons are equally valid today. And so I think part of it is you get people in who just think they know better than their predecessors, or who don't bother learning the lessons of history.
Paul Washington, thanks for being with us today.
My pleasure, Steve.
And thanks to all of you for listening in to CEO Perspectives. Please share CEO Perspectives with your colleagues, with your friends. Send it to your bankers. They could listen too. I'm Steve Odland, and this podcast has been brought to you by the Conference Board.
You have been listening to CEO Perspectives, a podcast by the Conference Board.